It's the entire system is based on debt. Debt is now the foundation to the whole system. The problem with debt being the foundation is when interest rates go up, the foundation gets thinner and thinner and thinner until it cracks. And just to go one step forward, the reason you want to own gold and the reason you want to own silver is because they cannot bankrupt in a world that is going to completely bankrupt. The foundation of the world, because it's based on debt, and I mean, debt defaults, and debt will default, and that's what people are going to find out, is that there's no foundation under the entire system, both the real economy and the financial markets.
The global financial system is currently resting on a foundation of sand, built entirely upon a mountain of unsustainable debt. As interest rates climb, this foundation thins and fractures, leading toward an inevitable systemic collapse where debt defaults become the rule rather than the exception. Bill Holter, a renowned financial writer and precious metals expert associated with JS Mindset, argues that we are approaching a moment of total systemic bankruptcy. He emphasizes that in a world where the real economy and financial markets are inextricably linked to credit, gold and silver stand alone because they carry no counterparty risk. They cannot go bankrupt. Data reveals that with global debt-to-GDP ratios reaching record highs, the rising cost of servicing this debt is creating a death spiral for fiat currencies. When the credit markets finally freeze, the lack of a solid foundation under the banking system will be exposed, leaving physical bullion as the only remaining store of value. Protecting your wealth requires moving into assets that exist outside of the debt-based ledger before the cracks become a total canyon. Now, we present the clips from Bill Holter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
It's the entire system is based on debt. Debt is now the foundation to the whole system. The problem with debt being the foundation is when interest rates go up, the foundation gets thinner and thinner and thinner until it cracks. And just to go one step forward, the reason you want to own gold and the reason you want to own silver is because they cannot bankrupt in a world that is going to completely bankrupt. The foundation of the world, because it's based on debt, and I mean, debt defaults, and debt will default, and that's what people are going to find out, is that there's no foundation under the entire system, both the real economy and the financial markets. We would have events, and I would say this is really bad and has the potential to collapse things. But I was not jumping up and down saying the markets, the world's going to end tomorrow or in 60 days or 90 days or whatever. It's a glide path, if you will. I mean, yeah, if a pension goes out of business or two or three, yeah, they can probably backstop that. Can they do that if the entire system goes? No, it's a joke. Your true CDS, your true insurance policy is physical gold and silver. End of story. Because they cannot default. And they are real money. And when this thing goes, you're going to have capital from all over the world trying to find the last safe havens that can't default. And by definition, gold is money and silver is a hybrid money. But neither of them can default. And they will be, and we talk about this, me and Jim talk about this many, many times on interviews. They will be, gold and silver will be the last men standing. Don't get into gold. Don't get into silver. It's so volatile. And they've said it forever. And I guess, go back to the year 2000. They're telling you stay out of gold at $300. Don't buy $4 silver. It's just too volatile. Well, guess what? Yeah, it was volatile. It was volatile to the upside. I mean, gold and silver have been the best place to have money since in this century. And it just sits there and sleeps and cannot default. And let's go back to what do you say to these people? First off, gold and silver don't do anything. They don't go up. They don't go down. They don't eat. They don't argue with you. You get to sleep at night knowing you're not going to default. What happens is the currencies go up and down. And that's reflected in the measuring stick, in the yardstick. The yardstick is gold. And what the yardstick is saying is that, okay, I mean, going back to the year 2000, and let's just use $300. The yardstick says that the dollar has lost 95% of its value, whatever the math works out to be, since the year 2000, the dollar has lost that much. You could buy 1 ounce for $300, or $1 was 1/300th of an ounce. Now $1 is until a couple of days ago, is 1/5000th of an ounce. Now it's 1/4500th of an ounce. So I mean, it's gone up 15-fold if you look at gold going up, but that's not what happens. It's the dollar going down. Well, gold and silver, and I said in January, gold and silver were due a pullback, without a doubt. And the pullback has been aided by naked paper sales. I mean, the naked paper sales have been used since 1975, since the Comex began. But they really learned in 1987 when the market crashed, because a whopping $6 million is what saved the system. The only options that were open, I think, were not the S&P 500. It was Value Line, or one of the smaller ones, and $6 million went into that, and it saved the market. And what they figured out after that event was that they could bully markets with derivatives to make them go up or to make them go down. And that's what they've done. And I mean, there's proof of that. JP Morgan paid $920 million for bullying silver from 2005 to 2013. They paid $1 billion fine. Just understand that if you were thinking about buying gold or thinking about buying silver in January at the peak with silver, you can buy the same ounce 45% less, and the correction has already taken place. I mean, it's not possible because they can't default, they can't go to zero. And if you look at the demand side, the physical market, the real market, paper markets are the tail, physical markets are the dog. The tail for years and years has wagged the dog. But if you look at the physical markets, silver's got a 450 million ounce per year deficit. And in the words of Elon Musk, you can't short a shortage. And that's what's happening at this point. So once this episode is done, you're going to see, I think it will only probably take 60 to 90 days. You'll see new highs in both gold and silver from wherever the bottom is. And I don't think it's going to be much further from where we are right now. When people ask me how much should I put into gold, or how much should I put into precious metals, my standard answer is whatever you don't want to lose. Because when this goes, whatever you don't have in precious metals is going to have a counterparty, and there's counterparty risk. There's going to be a broker involved, or a bank involved, or an insurance company, some type of financial institution involved. And the question is, when the shithouse comes down, is that institution going to survive? And the answer is likely no. So my standard answer is, whatever you don't want to lose, put into precious metals, because they can't bankrupt. And bankruptcy is the future of the world.
The global financial system is currently resting on a thinning foundation of debt that is destined to crack as interest rates rise. Unlike fiat currencies and traditional financial instruments, physical gold and silver carry zero counterparty risk. They cannot go bankrupt in a world rapidly heading towards systemic insolvency. While critics often point to volatility, gold has outperformed nearly every other asset class this century, serving as a stable yardstick that reveals the dollar's 95% loss in purchasing power since 2000. Current market pullbacks, often aided by naked paper sales and derivative manipulation, represent a strategic entry point for those seeking a true credit default swap against the banking system. With a massive 450 million ounce annual physical deficit in silver, the market is approaching a reality where paper tails can no longer wag the physical dog. As institutional backstops fail and pensions face instability, capital will flood into the only safe havens that cannot default. The most prudent allocation to precious metals is simply whatever capital you cannot afford to lose, as they will undoubtedly be the last men standing when the debt-based economy finally reaches its inevitable conclusion.
I think really what's of concern, the canary in the coal mine right now, is private credit. I mean, that's blowing up. You've already seen commercial real estate get hit, and obviously the debt behind that. But the private credit markets, there's 3 or 4 hedge funds now, sponsored by big name banks, Blackstone, BlackRock, that have gated investors. In other words, you want $100 out, but they'll only give you 7, or you want $100 out and you can't get any. So that is It's a problem. And from an additional standpoint, it's a mental problem because that's the way bank runs get started. That's what happened in the California banks. What was it, 2-3 years ago? And those came out of nowhere. This is very reminiscent of Bear Stearns in February of 2007 with their 3 funds that they gated. And what was it? It took a lot longer than I thought back then. It was a year, call it a year and a half before everything unwound. But that was definitely a signal as to what's coming. And I think private credit is telling you that also. And on top of that, yields all over the world are beginning to rise. Well, I mean, it's absolutely critical because there's more debt in the world, obviously on a total basis. There's no question about that because the system's bigger than it's ever been. But there's more debt per GDP. There's more debt per any ratio that you want to look at. And when you have a system that's saturated in debt, if you raise interest rates, the system chokes. Look at the Federal Reserve. Look at their balance sheet. It was just 3 years ago I looked at it and they had $65 billion total in equity holding the whole system up, holding their portfolio up. But they now have a negative net worth, and that's because they unloaded all sorts of called lower rated bonds that they've held on to, and just the regular U.S. Treasury portfolio. As interest rates go up, the bond values or prices go down. And I think they're between $100 and $200 billion net negative equity at this point. And I mean, follow that through to all the insurance companies. The insurance companies, they probably have 60-70% plus of their portfolios are in bonds. And that's what is the bedrock to these companies having value, to these companies being able to service the life insurance contracts, the property casualty contracts, etc. So higher yields and lower bond prices in a over-leveraged system becomes a disaster at some point. Get out of the system. Because when this happens, you're not going to have access to your cash. You're not going to have access to your stocks, your insurance portfolio. You're not going to have access to anything. And even if you did have access, you'd be down 60, 70, 80, 90% if you were able to sell. I would just say I've talked about the great taking, 100 times now. Take the hour to read or watch The Great Taking and understand that it's very, very real. It's 100% real. The laws are on the books. When you put money into a bank, you're no longer a depositor, you're a lender. When you put money into a brokerage house, and I just did this, I don't keep any stock at a broker. I did move some stock, I think it was last Thursday or Friday, I brought it into the broker's office, and it was a younger guy, maybe 25, late 20s, and he goes, wow, I haven't seen one of these in forever. And he's talking about the stock certificate. And I asked him, I said, have you read The Great Taking? He goes, what's that? I said, when you go out of business, these shares that I'm depositing, they're gone. They're on your balance sheet. I'm going to lose them. That's why I don't keep anything with you. So it took him about 10 or 15 minutes to go through the process of taking the certificates in. But when he came out from the back room, he goes, I'd never heard about that. He goes, really? When I deposit money in the bank, it's not a deposit. I'm a lender. I said, you can bet your ass. It's in law. I mean, the ink is dry all over the Western world to fleece investors everywhere. And it doesn't matter whether you have 10,000, 10 million, or a billion. It doesn't matter. If your institution goes down, you're toast. I would say, I would ask the question, well, let me ask you this. Do you believe that the U.S. government is broke? And 95% of the people, when you ask that question, they'll say, well, of course it is, but it doesn't matter. In this case, it matters because who's the backstop? Who's the insurance company? And I think the biggest laugh of all, and I did an article on this, probably 12 years ago, maybe more, back when CDS was, it was a big thing, and there was CDS, big movements on various sovereign bonds. The biggest joke to me is that there's CDS on U.S. Treasuries. How is that possible? How is an insurance company going to pay for the default of the U.S. government? So, I mean, you could buy all the CDS you want. you're not going to get paid.
The fracturing of the private credit market serves as the modern canary in the coal mine, signaling a systemic liquidity freeze reminiscent of the 2007 Bear Stearns collapse. As major institutions like BlackRock and Blackstone begin gating investors, restricting access to their own capital, the psychological trigger for a global bank run is already being pulled. The Federal Reserve's own balance sheet has moved into a massive negative net worth position, leaving insurance companies and pension funds vulnerable as rising yields decimate the value of their bond-heavy portfolios. This is no longer a theoretical risk. It is a mathematical certainty in a system saturated with more debt per GDP than at any other point in history. Investors must understand the legal reality of the great taking. When you deposit funds or securities into a brokerage or bank, you are no longer an owner, but an unsecured lender to an insolvent institution. As the ink dries on laws designed to fleece participants during the next bail-in, the only way to truly opt out of this systemic failure is to hold physical assets like gold and silver outside of the banking system. When the ultimate backstop, the U.S. government, is itself broke, paper insurance policies like credit default swaps, CDS, become worthless. The only true insurance is an asset that carries no counterparty risk and remains real money when the digital ledgers are wiped clean. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Thanks for watching.